Welcome to the Broken Pie Chart Podcast, episode 301. I'm your host, Derek Moore. With me is my co-host, Jay Pestrichelli. All right, Jay, starting a new streak. Just did 300, 301.
I know, 301. Does it feel like a letdown? Like, whoa, it's 301.
Kind of like the, going out on the day after New Year's Eve. It's sort of anticlimactic, right?
Yeah, I mean, New Year's Eve's the party time. Yeah, I know. Did you get any good comments from people on congratulations on 300?
I did get a couple good comments, and
did you have to send any hats out? Did you find any OGs?
No. Again, I have no idea who the original one or two listeners were to that first one. No.
All right.
And, no,
sorry.
I don't have hats anyway because I know it's
easy to make a hat,
I know. Well, we've talked about.
If you showed up, you could have made one.
I have to look into that, because there's sites now you can upload your logo, and then if anybody buys it,
sure, it's very easy.
We'll have to do that. We'll have to get
need
that
help
approved.
with that. I know a guy or a gal.
You got a guy? All right.
Yeah,
got a guy. So, speaking of, the market's made another all-time high. I don't know if you're aware of that.
Yeah, no, we're recording this Friday, the half day, all-time high on a Friday.
Strong.
Yeah,
strong move today. I mean, 60, 32, 38. High is 60, 44, 17. So, it's been bouncing around the 6,000 level. We know the law of round numbers in technical analysis says sometimes you have trouble getting above or below numbers, but
we're above.
We are most definitely above. So what does this mean? I mean, is it we off to the races now? And by the way, we buy and we hedge. We're just kind of chatting about markets here, but we broke some resistance. I mean,
if you're a technical analysis person, you look at things like moving averages and higher highs and higher lows. The trend is still your friend. Mm-hmm. I know it's true because it rhymes. Has to be. So I would say, this continues to show us that the trend is up. We haven't seen anything with a strong enough reversal. I thought maybe a few weeks ago, maybe we had just kind of topped out after 6,000 and you'd see a pullback, to 5,700 or something like that. And I think that's still a possibility here. But it's we've talked about where we are in the cycle. You got, this last month of the year. We talked about, what happens between, the vote, election day and inauguration, and those are bullish trends. So it seems like the market has been following the election cycle playbook pretty well. But I'm with you. I mean, I like looking at what it costs to re-hedge here. VIX at 13.5. Hedging is going to start getting cheaper, right? It's one of those things that, is this a good time to roll your hedge? We rolled our hedges on some of our portfolios a few weeks ago. I think we talked about that. But, it's you want to buy insurance when it's cheap and when you're also insuring more, right? What you insure today is, a bigger value than if you were buying insurance, say notional 6 months ago. Yeah. So look, this is all very, it seems very positive. It may just be one of those little creep ups. We did get kind of a low volatility indicator, right? One of our triggers fired.
That's right.
Said, it's bullish still, yet, low volatility. So it might do it in a really, boring fashion. Although I'd tell you 0.5% a day, that's not so boring to me. Take that all day. It's fine.
Yeah. No, that compounds really well. I think what you saw too is, yields pulled back. So if you look at the 10-year yield, that pulled back. The dollar pulled back, commensurate with a pullback in yields. And we know that, when you look at dollars, that's my dog's very excited about.
He loves talking about dollars.
Loves the dollars.
It's his name, right? Dollar?
No.
You're going to name your next dog Dollar, though.
Potentially, yes.
Yeah.
Potentially. So the dollar, this is like the fly in the ointment for me is the dollar. Because if the dollar continues to go up higher, we know that earnings calls, and we know this in 2022, you kept hearing it in the calls. They would say, oh yeah, but for interest rates or but for currencies, our earnings would have been X or Y. So this has been a welcome pullback in the dollar, a welcome pullback in rates. We don't know.
What are some of the things that could push the dollar to be even stronger, if that's what you're worried about? Like, what's the agent of cause here that you're?
Well, it's interest rates. So the idea is that, if our interest rates relative to the rest of the world are moving higher, or they stay high relative to, compared to the rest of the world, like money flows in when you have these carry trades and you have, do I want to own dollars? Do I want to own something else? Well, if the interest rate is higher in the dollar versus some of the other ones, you want to own dollars. So I think that's part of it. It could be some political things where there's been, the Treasury Secretary was chosen, and for all intents and purposes, he's a market guy. I think he's a hedge fund guy, and I don't think, with respect to tariffs, I don't think necessarily he believes in tariffs long term. I think he believes, as sort more of a tool. But if we get a measured downturn in the dollar, a rates easing, and when I say rates, I'm talking about the long end, I'm talking about the 10-year. That's welcome for markets, Jay.
Got it. So, okay. So even though if the Fed eases, but still it may not mean that the longer term, longer duration, the 10-year, 30-year necessarily comes down. Those can go up. Those have been going up, right? So. Yeah.
You know what playbook we're following, though?
Oh.
1994, 1995. So 95.
I wish you would have mentioned that at some other podcast.
I've only been mentioning it every podcast for the last 2 years.
Right.
But here's what happened. We have tracked, so in 95, first rate cut, didn't have a recession. Rates went up. Rates went up after they cut rates. Rates then came down, and then for a while, and then they wound up a point higher. I think it was 6% and wound up at 7% a year later in 95 to 96. So, maybe we're following that playbook where rates are going to ease for a bit and then go back up. Like, rates going up isn't the worst thing.
No, I mean, there's an argument to be made in a school of thought that rates going up are tied to the GDP, gross domestic product, right? Saying like, look, an economy that is growing should have higher interest rates. So if we have a strong economy, it would not be out of bounds for rates to go higher.
That's right. You want, again, I go back. If we have a strong economy and rates need to stay high because the economy is strong and GDP is growing, that's a great thing.
Yeah. But so why does everybody want rates to go down then? Why is that?
We don't.
Oh, we don't. We don't want rates to go down? I thought lowering rates was bullish for the market.
It is. But I mean, the reason why rates are going down, we don't want the reason to be negative. That's what I'm saying.
I think that's the whole point, right? That's why I'm asking these, silly, obvious questions. It's to get to that point. Like, if the economy is strong, if you have corporate earnings that are growing and growth in the country is strong, it's okay, right? Rates become less and less impactful. If you have a negative reason, like we're going to get a jobs number next week, right? So unemployment, or you have the R word, the other R word, recession kind of kicking in and hurting corporate earnings, then in those scenarios, dropping rates are probably bad because it's meant to like offset a reduction in growth. Growth is still better.
That's still right. Better.
Yeah.
All right, let's think about the market. So you're in Timur. You mentioned the presidential cycle or market cycle as you're in Timur, had tweeted something out or X'd something out. Presidential cycle when we've had a down midterm year. And by the way, people have said, hey, why don't you guys do video? Well, we're not doing video. I don't think there's any plans to do that. But if you go to zegainvestments.com and follow our blog, we've started to put some of the charts that we talk about in the broadcast into that blog article. So that's a good way to do that. But this chart seems to indicate that the first year of a presidential cycle, and this doesn't mean it's going to be the case. They, we'll see, and after the inauguration tends to be sideways to a little bit down and then go up towards the end of the year. So, Jay, who knows if this is going to be the case this year, right?
Yeah. So we had a term election year that was negative. That was 2022. I don't know why it still feels like yesterday. When you talk to clients, they seem to remember 2022 pretty vividly. So 2022 is negative. Then the subsequent first year, so then you got year 3, year 4, the election, great changes. That's a fairly sideways market with a dip for the first 6 months and then a recovery back to kind of break even, right? So, I mean, if the market was to continue to follow that historical pattern, it would tell you this is not a bad time to hedge, right? When everybody's optimistic, hey, rates are going down or rates are going to be positive from our growth is strong, all those reasons. Maybe that, I'm not, like we don't try to time the ins and the outs, but we do try to take advantage of when to, put on a hedge or, lock in your gains. If this is the potential for the market to be flat over the next year and you don't want to ride down the risk because who knows what can happen. I'm sure we'll start to see things with tariffs and immigrations and all sort of, global impacts of things. Yeah, why not hedge if you're expecting the flat year with some volatility in it? Like according to this chart, it's hard to read it. That dip, right, for the first year looks like, at least a 5 to 10% drop is what historically tells you in this cycle. So yeah, not the most optimistic for the first year of this presidential term.
Well, but here's the thing. December, as you mentioned, is a historically solid month. In election years, and this is from, let's see, is this Ryan Dietrich or is this Carson? Carson had put this out. And yeah, November and December in election years, typically positive. Who knows this December, but Yeah,
it's just starting, right? We're just kicking in. And November, though, was a pretty strong month. And so it also looks like, during an election year, it's a fairly strong month. And the average over the last 10 years, it has been the strongest month of the year. So November following suit with what it's supposed to do. If it follows through in December, yeah, maybe that's the play. If you get a few more gains in and if there's something you feel you have to time, don't time your in and out, time when you're adding hedges. So I don't know, Derek, we like adding hedges when you have the VIX in the low teens. Maybe that's something to consider.
Well, this goes back to the whole thing is people try and game the markets. They try and predict, is the market going to go down? Is it going to go up? I mean, our view is just you buy the market and you add these hedges, which, as you said, are typically lower in cost when volatility is lower and things are better in the markets. If you're buying in March of 2020, if you're like, hey, maybe I'll protect my portfolio. Yeah, that's going to be expensive. Now it's not as expensive. So Derek.Moore at ZigaInvestments.com. If you want to know more about how we hedge, how we buffer, our quant strategy, any number of things. We do a lot of different stuff. And that's Derek.Moore, DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. But yeah, I mean,
people can get performance numbers there too, right? You want to see how the strategy
that's right.
is done. You go see it, see the historical stuff, all in the tear sheets there.
Yep, ZigaInvestments.com.
Of information.
That's right. So, yeah, we'll come back to some market predictions in a sec. I will say that, a lot of people think, the Fed has this 2% target. They also look at PCE, which is their preferred method. Bloomberg put out a graph, PCE core services, so not goods, just services, less housing, month over month. And one of the things you see is services is still relatively high. In fact, we had a 0.36% increase month over month in October. That was the largest month over month increase since March. Does this mean anything? Maybe not. But the point is, I think services are not really coming down yet.
Yeah, I mean, inflation there, the Fed's preferred measure of inflation definitely doesn't show the 2% number. Yeah, there's a handful of months that were below 20 bips, but only one, maybe two this year, maybe, right? February and maybe May. So I don't want to be an alarmist or anything here, but it's pretty clear inflation is not licked yet. We're still dealing with it. The economy doesn't look like it cooled off enough to drive prices down. We shall see what happens, the next year with any policy changes here. But I would tell you, the Fed should be in no rush. If I'm the Fed, and I'm not, I'm glad I'm not. Fed should not be in any rush to cut rates. I know its primary concern has shifted from inflation over to unemployment. Maybe that pushes them, but it's not like promising like woohoo, right? The Fed needs to cut rates all the way back down to 2%. It doesn't look like it's in the near future when their primary benchmark for measuring inflation isn't really showing a major decline.
I mean, the regular CPI is 2.6% year over year. So is 2% really important? Or maybe we just stick at 2.5 for a while? Like,
who came up with the 2?
What's a bunch of academics at the Fed probably.
Yeah, that's what I was going to say, right? Wasn't it a bunch of studies and say that's the right amount of growth, but also not, conducive to causing too much inflation, right? Yeah. I don't know why that's the number.
No, I mean, and core year over year, I think if you look at just core CPI, it's 3.3, the core. I mean, it's higher than they want. Super core is 4.3, I think, year over year. Super core is less housing. So less oil, less food, less housing, basically, is your super core. That's things like medical cost. And so I don't know. I mean, I think the reality is hitting people that, we may not be lowering as much in interest rates as we think, but corporate earnings are still good. We'll talk about corporate earnings a little bit later. I will tell you, for anyone has enjoyed our Bitcoin and MicroStrategies, we'll get a little bit at the end. But yeah, I think to wrap this up, Jay, inflation's not at 2%. It's not at 2%. So,
all right.
Housing, though, had a pretty good month-over-month increase. I know housing, if you go on YouTube and you can spend hours there, you'll be convinced in the first, half hour that housing is about to crash like, 1920 levels. At least there's people making. You and I are not in the housing, we're not investors in housing. I'm speaking for myself. It's not my forte. But I think this has been a little bit of a conundrum for people. And the idea that rates can be this high and housing is not going down, I think speaks to the idea of still a lot of people with low mortgages and there's not as much inventory, but looks like home prices went up 0.7% in October. So higher than people thought. At some point,
it's got to, the volume's got to kick back in just from natural, like everyone's waiting. And maybe that was rightful to, right for them to wait. But, you can only wait so long if you actually have to move. The amount of house you could buy with interest rates moving around, those are all linked together, but we'll see. But interesting to see the increase, to see that kind of a pop there is nice.
We want housing prices to go up. There's probably a sweet level of ascension or, a march higher that makes sense. But people, the wealth effect is increased when people have see their houses go up. A lot of people have wealth in their house. Whether it's a good idea or not, they can, tap that through a home equity loan. Although the home equity loan today would be probably 9%, right? Whatever the prime rate is.
Yeah.
So,
yeah.
This is higher. All right, Jay, the other thing I wanted to touch on is the conference board. This is from the Daily Shot on Twitter. Percent I mentioned that refers to people, but percent of people expecting higher versus lower stock prices in the next 12 months. This chart goes back to 2005. It's at 35.1%, which is higher than at any point going back to 2005. Is this like a contrarian indicator or?
Well, let's look at the other times when it was high, right? So this is the percentage of people so is this high or just being like, hey, I guess I'm interpreting this like it won't be a down year next year, right? Like that's all it's saying. You could be up 1% and it would be, that would qualify for somebody thinking the market's higher, right?
Yeah, I mean, is this really contrarian? Like, look at the high point.
Yeah, like what is that? The middle of 2017, right? The last time it was this high at 30%. of people thought the expectation was higher.
Middle of 2018. I don't know. I can tell you for sure. I mean, if people can't see this chart, but 2009, like 35% of people thought stocks would be lower in the next 12 months. So it seems like when this is very low, it's an interesting time to buy.
Yeah, and actually, at the beginning of 2003, 20% thought,
or 23, yeah.
Sorry, 2023. Sorry.
Yeah.
20% thought it would be down, right, the next year.
Well, sure. 157 out of 158 leading economists said we're going to go into recession. I'm making up those numbers now, but it was
because it was so ridiculously wrong.
Yeah.
So I don't, generally these are contrary, sentiment measurements are contrarian indicators. But I would tell you, if you put me in that list, the next 12 months, I'm probably at least, plus 0.1% feels okay to me. But who knows? Like, again, it's a hard survey to know. I don't know.
Well, let's think about the next year. Let's skip ahead in our list to Wall Street S&P 500 targets for year-end 2025, Jay. This is CNBC had posted this. Deutsche Bank, I'll just go through these. They think it's going to 7,000. Good for them, by the way, for actually saying 17% higher. BMO, 6,700. UBS, 6,600. Barclays, 6,600. RBC, 6,600. CFRA, 6,585. Were they trying to play the game like the Price is Right game there? Goldman Sachs, 6,500. Morgan Stanley, 6,500. So I'm just going to say it. I think this is lazy. All right. And it's lazy because...
Tell me why it's lazy.
I mean, aren't they just taking the arithmetic average and just basically applying it?
Average? Like, what's the average the market has been up?
All right. So since 1928, and there's two different ways to look at this. There's the arithmetic average, which just looks at what is all the up downs, all the years, and you divide by the number of years. And it's about 11.66. This is from Aswath Damodaran's spreadsheet. I'll link to it because it's a great resource.
It is a great resource.
It's awesome. It really is. Like if, the fact that he's put it's stocks, T-bills, bonds, corporate bonds, real estate, and gold since 1928, the returns. The geometric, or, what a lot of people would say, the CAGR, the compounded annual growth rate is more like 9.8%. So I feel like these guys just did like 9.8 or 10% on the markets. And
so they just took the average since, 1928 and said, I'm going to go with that.
Yeah.
That's why I think it's lazy.
That's why I think it's lazy. And by the way, if you look at the market returns, Jay, how often does the market actually give you, 11.66, which is the arithmetic average? Okay.
I mean, exactly, plus that number, right? Plus or minus 1%. No, it's not often. It never really lands on the actual average. I guess 2016 was pretty close at 11.7, 11.8.
Yeah,
pretty close. But no, it doesn't normally land right on the average, right? Okay, gotcha. So, but it's still the average. I mean, it probably happens. You're probably closer throwing darts than at the average than you are, nailing the exact amount. So like what? You would prefer there was some sort of predictive rationale here that says because of X, Y, and Z, these things, and we think these all tally up to, you'd like a nice quantitative set of data that gives you an outpoint.
And to be fair to these, let me take back my comment for a second. I'm sure they released 20-page reports that have all that in there, and I can find those. But
they all came up with the same number.
No, it's just like, come on. Like, really?
65 to 7,000, most at that 66, 6,500 level.
Is this a contrarian indicator, Jay? Like, I
mean, it feels like, they're not always, where's the bear? Where's the bear prediction? Like, there's always someone who's like, oh, we're going to hit 4,000. We got to retest that low. Like, where is that in this list? That's a little worrisome that I don't see a bearish prediction from anybody.
Is Michael Wilson still doing the Morgan Stanley stuff? I don't know.
I don't know.
He was the one who said 4,200 last year.
Well, Morgan Stanley's at 6,500 here, which is 500 points higher. But they're on the lower end, by the way, of the projection. Them and Goldman Sachs are at the lower end of the projection. But still, where's the bear case? So going back to your sentiment question, all of the big banks also think the market's going up. I don't know. I don't like it. I don't like it when they all agree.
No, I don't either, which is why, always be hedged, right? Because if it turns out this is the case, great. You have hedges anyway, but if you do get a pullback, and by the way, it would be perfectly natural to have a 5 or 10% pullback. We have those all the time in the markets.
Yeah.
I don't know. It just, I'll find out. I'll find, their research reports. I'm interested. I mean, especially what's really interesting too is if we can skip down to, Bloomberg has a function where they have the earnings estimates and they have the forward price multiple. So we're trading at 22.74 times the forward 12-month earnings estimates. And the E in that equation can go up. These are just estimates. We don't know what the actual numbers are going to be. It can go down. So, and markets, by the way, can decide that they're okay trading at a higher premium and staying at a higher premium. But, the argument against somebody, or the argument for somebody going out on a limb and saying, no, actually, I think we're going to end the year at 5,800 or 5,500 would be valuations, right?
Yeah. I mean, that's kind of like if you had to pick an emotional representation, it's that rate, that valuation rate that I think always kind of kicks in. So you get the sense. And so you would say historically, this is on the higher end of PE ratios, right?
It's not on the low end, that's for sure.
What's the average? Let's remind everybody what the average is. 16-ish, right? 17, 16?
Oh, well, since 2000, it's probably higher. Remember, that's the thing too. When you're trying to compare different eras, I mean, you had chemical companies and oil companies as the biggest companies, and now we have, Google, Microsoft, Apple. These are different companies. So I think it's, you should expect higher multiples on companies like that. Okay,
it's different mix of companies, but still, where did you say we are now?
22.74.
22.7. Yeah. Okay. There's anybody who's valuing, who would use this as a measurement would say this is on the higher end of valuations.
Nope, that's right.
Yeah.
That's right.
All right. So now you got, let's see, we got, how many things we just say? You got this presidential, you're really a downer on episode 301, by the way. Well, you got the presidential cycle that, isn't projecting very much. You've maybe flat, maybe, some down periods. You've got, we just talked about inflation isn't beat. Okay. You've got consensus on growth, which is a contrarian indicator. You've got all the big banks projecting growth, which is a bigger contrarian indicator for us. And now you just told us the market's expensive from a PE ratio standpoint. Is that what just happened today?
That's right. Now, or I would say the 1994, 1995 corollary that, this bull markets are contagious.
What happened in 96 at this point? Like where we moved on here or what?
96 was up and up since. So when they lowered interest rates in July 95, the market had already been up over 20% and then was up another 20% the following year.
Okay, so if we're going to follow that, you got the, 30?
Then you go to 7,000, right? I mean,
you go over 7,000. But there's, look, besides the actual tracking historically, all this data you presented today says, I don't know what to say about it. You're definitely a Debbie Downer today, Derek.
Well, we like to rotate.
Okay.
Can I tell you, let me spend a second on valuation too. So right now, the forward 12-month estimate for earnings on the S&P per share is 263.80. Let's just round up to 264. If we're trading at here, let me do some math here. So if we were just at 20 times 264, what is that? 52.80?
52.80, correct.
Yep. 23 times 264 is 60.72. 20. I guess I should do 21 times. 21 times 264 is 55.44. The reason why people, professionals, institutional people spend a lot of time on the valuation, because look at the difference of what just 1 point of forward, PE ratio changes. At 23 times, you're at 60.72. At 21 times, you're only at 55.44. That's why the valuation is so prevalent in discussions in the institutional circles, because you're like, it makes a big difference. Like just a small little change in how much investors are willing to pay for future returns, future earnings, right?
Yes. Well, that's the whole multiple thing. That's why it does that, right? It's multiplication there. But yeah, I think so where we are today for next year's earnings is the way to look at this, right? So you got to say based off of the price today that we said was what, 30 something, right? And then you look at what earnings are for next year, and then that gives you this forward PE. But if all of a sudden your earnings next year are higher, then it turns out that your PE wasn't overblown or wasn't inflated, right? So you still don't know what the number is going to be. It's still just a projection, right?
Yeah, and really, if you want to look at December 31st of next year, you look at the year plus one estimate, which right now is about 299. So if you take 299 times 23, that gets you 68.77. So to get to 7,000, your multiple will have to go up, or your earnings estimates would have to go up, or buybacks. You could have buybacks too. So that's the other thing that gets a little technical.
Push earnings per share up because there's less shares, right?
That's right. Yeah. That's right. So buybacks and things like that. So this is, this is why when you do estimates like this, you're basically trying to guess what's the forward 12-month plus one estimate's going to be. Essentially, what are the estimates going to be, for 2026 in December of 2025? And what's the multiple going to be? And how much buybacks they're going to be? And who's going to be in the index? What subtractions, additions are going to be?
Oh, yeah, you have so many unknowns here. You're absolutely right. Yeah.
That's right. So, and I think there's a couple companies that are, I haven't looked, but there's a couple big companies that potentially could come into the index. So, all right, we killed this enough?
Oof. Yeah, I'm depressed. Let's move on.
You shouldn't be depressed. Markets go up more often than they go down.
That's what I was believing, but you're telling me the party's over.
I'm just telling you, it's if you're going to say what's going to be the return attribution for the next year, if you're at a 16 forward PE, you'd say, oh, we have a lot of PE multiple expansion possible.
Yeah, that's fair.
Yeah. But what we don't know is earnings. And if, let's say, we get a lot of deregulation and we get an extension of the tax cuts or further tax cuts, and the economy keeps growing, we could see an earnings resurgence as well. So who knows? I'll let you know what I know.
There's a chance.
This is why we buy and hedge. Here's the thing. How many people do we talk to, Jay, when the market hit 5,500 and they said, I don't know, I'm thinking about going to cash? We had those discussions.
We absolutely do. And what is our answer? Just we'll tighten up your hedges.
That's right.
Stay invested. Yep, totally.
That's right. How many people went to cash in October of 2022? Said, I'm done. I'm done. I'm down. Just saying in general, investors who are down 20%, they're like, oh, this isn't going well. March of 2009. Like, good luck picking this. So, all right, we need to talk about Bitcoin. We need to talk about MicroStrategies. We give the people what they want, Jay. People are interested.
People want more MicroStrategies. Okay, what can we talk about?
Well, I think one of the things that people found helpful is to think, there's a lot of arguments about why you would buy MicroStrategies over Bitcoin. And, we talked about how the value, the net asset value of the Bitcoin that's held by MicroStrategies is less than, actually just buying Bitcoin. But what was helpful for people is when we explained, if you buy MicroStrategies, you believe the ratio of what it's going to do versus Bitcoin is going to be more positive than Bitcoin. In other words, if Bitcoin goes up, you're buying MicroStrategies because you think the ratio is MicroStrategies goes up more. It could flip around too. And if it goes down more than Bitcoin goes down, that's a problem too. But Jay, we were looking at, just what is the option market for, not forecasting, but what is the option market actually showing us in MicroStrategies? And, we look at volatility a lot of times. I know, Jay, you and I spent a little time, not too much time, but, like 15 minutes, we were just saying, look, what are the December 25s telling us? And
yeah, so now, I'm happy to talk about options. By the way, difficult to trade options on MicroStrategy, right? So much volatility
yes.
In these options right now. It reminds me of, Tesla circa 2018, 16, 17, 18, 19. Like, it was just really difficult to trade the options on this. So if you're looking at the 1 year, let's call it December of next year. Yeah. So a few things we look at. We look at what's the market predicting the move would be, right? This is one of the things we like to talk about. And that is reflected in the price of the options. If you buy the call and buy the put, where do you break even? How much movement in the stock gets you even if you just bought kind of the at the money options? And right now, if we were to say, look at the 390s, it's projecting to have a move of $360 from here. I'm going to round to 300. It's 363. Let's round to 360. So it's trading at 387. It's projected to move $363 in a year. It means there's no downside almost no downside where you could make money on that trade.
And
right?
and Jay, just to clarify for the audience, the listening audience. So that would be buying the at the money put and simultaneously buying the at the money call. Not saying that's a good trade or not a good trade. But you're saying basically when you add up the cost of that, if you were to buy that and if the stock went to zero, you would only make like a tiny bit of money. That's how high the premiums are.
$25.
Yeah. Zero goes to zero from 387.47.
And so you have the long put, you make $25. Your break even to the upside, right, in that scenario is what? 390 plus 363, right? So do that math, 753. Wow.
So it goes to 753 in the next year. Obviously, you can trade in and out of these. You make nothing.
Now you're
lose anything.
Profitable. So yeah, it's one of those things that, and if again you hold it to the end, and there's all just saying at the end, that's what the market is projecting you to go. So it's this is a symptom of an option that has quite a bit of volatility in it, over 100% actually right now. So so which way is the market really leaning, right? Basically, let's say it's almost 100% move up or down is the way the options are priced in. So we like to look at, we call it the skew, but let's just take a look at the options that are 10% out of the money above and 10% out of the money below. It's a good way to kind of see where is it more expensive, where's there a premium built into the options. And so if you were to look on the cost on the downside, I guess we'll call it the 350s, about 350s. That's 10% down. Those are trading at, let's just say the mark is 146 as of the close of Friday. So $146 to the downside, and then the 430s, which is about 10% to the upside. The mark on those is about 180. So what it's telling you is 10% up will cost you 180, 10% down only cost you 142. So there's definitely a positive skew there. There's some interest rates built in there, right? There's a cost to carry, which is like $17. So once you get past that $17, there's still this premium on the upside. So people are still paying more for calls than they are for puts. That is unusual, right? That is a bullish signal from the options market. So you asked, what is the options market telling us? It's telling us it's got a lot of movement baked in, and the bias is to the upside based on that information.
It is crazy how expensive. And I mean, I shouldn't say they're expensive or cheap. They're baking in the expectations of the market. I mean, it's not necessarily expensive if the market thinks it's going to go that much. So it's sort of relative.
A year ago, where was MicroStrategies? Like if we were doing this exercise a year ago, right? It was trading at $57, $55, right? So it was trading in that range. if the volatility is it could double in a year, you'd say 114. That seems kind of, that's a big double. That's where the movement is. It made it past 114 by what date is this? By March 4th.
That's right.
So it had already done that first double, right? If the options had baked that in. And then, by the way, it traded sideways for quite a while. And when I say sideways, I'd say range bound, right? It was stuck between, 100 and 200. Most of the time it's been between 125 and 175. And then, you have the breakout of, the election related bullishness. But it stayed range bound for quite a bit of time before it broke out. So, maybe it goes in fits, but you don't know. It's hard to know. But the market is just pricing a lot of movement one way or another.
Well, think about it this way. I mean, the back of the envelope says, and the back of the envelope is actually even more, but the back of the envelope is like, this stock in a year, the options market's saying it could be between 0 and,
750.
750. I mean, that's really what the options market's pricing in. Think about that.
So what if, it seems almost crazy to even bring this up. What if you think the options market is wrong, right? And it's not going to be this volatile, right? What if, let's face it, it's highly correlated to Bitcoin on MicroStrategy. What if Bitcoin is sideways for a while and just can't press through 100,000? By the way, who knows? By the time people hear this podcast, it might already be over 100,000. As we're recording this, and I know you love when I talk about the price of Bitcoin, it's 97,000. So, it usually seems to be, a morning thing, like a Saturday morning thing when you see a random pricing like that. But who knows, as you push through the limit orders that are all set there. But Bitcoin may stay 100,000 for the next 6 months, right? May fluctuate from, 90 to 110. Maybe it's more of a 105 to 95.
Yeah.
If that happens, these options are getting it totally wrong. All the time. We've given examples before. Right after NVIDIA earnings was a great example. It didn't move at all, but there was an 8%, movement built in. It's one of those things. You don't know. The options are not always right.
One of the things, you mentioned the 10% out of the money put. The cost to hedge on an annualized basis is like 35%. So you would pay, on the S&P, what is it right now? Like 2.9, something like that?
Yeah. Yep.
2.9 annualized cost of hedging. 35% annualized cost of hedging for MicroStrategies. So, that's something there. We did have a question, I promise you, Jay, I'm not going to go into the convertible bonds in depth. I will tell you that a good way, this is what, sometimes people tell me, oh, I'm watching this YouTube video, there's a great saying, if you want to see how wrong some information is, pick a subject that you know a lot about, and go and watch people explaining it. And you'll realize that, like, if I watched the video of somebody trying to build an engine for a car, I'd be like, oh, he's making some good points. Probably this guy knows what he's talking about. Could be totally off. You should see some of the stuff that people have sent me from the internet. And so can I just explain for a second what a convertible bond is? I
mean, do it at your peril. You say give the people what they want. You think they want to hear about convertible bonds? Go for it.
So convertible bond, if I look at, let's say, they've got a bond that expires December 1st of 2029. And the convertible bond, it's priced at $95.24. So when I say priced, that's generous because it says as of November 27th. Bonds don't trade all the time. And the trading in bonds is a lot different than equities. Won't even get into that. So you would pay, let's just call it about $950 for a $1,000 par bond. And you would have the right to convert into shares at a conversion price of this one in particular, $672.41. I'll just round. So you could buy one bond, you could convert into 1.4872 shares at $672.41. MicroStrategy's, what did we just say it was? Around 387.5, right?
Yep.
So a convertible bond is interesting because it is a lot like options. When you buy the bond, you'll have a premium to sort of the intrinsic value or the convert rate. So that's what people are doing when they're buying a bond. And you can buy and sell these bonds. Again, they're not the same type of market, but you pay for the bond. It may or may not pay interest. These are zero coupon bonds, so they don't actually pay interest. And then it matures. It's convertible until November 29th of 2029. And there's also something called a put provision in there that, I won't bore everybody, but that's until June of 28, where you can actually, get sort of your par value back. So I just bring this up because convertible bonds are similar to options because you are paying a premium for these and you have the right to convert into shares. And I know people are making this more intricate than it needs to be. But typically companies, when they issue converts, they can pay less interest because you have the optionality to convert into shares of stock. So that's all these are. I'll stop there, Jay.
Well, let's answer two questions.
Yeah.
What if it doesn't get $650? What happens to your bond?
Right. So when it matures, it would mature at par value in theory. And if you paid $950, you get $1,000. And
got it. As long as MicroStrategy is still in business and they don't default, correct?
And yeah, that's right. If they can pay, and your annualized, your yield to maturity, which is basically your annualized return, then would be like 3% per year or something like that.
It's less than 1%, right?
Yeah,
$50 over how many years on 900? Great.
So it's your opportunity cost.
Okay, so that's first. So arguably though, it's like you're getting a little bit of income while you're waiting. Little bit, but nothing. Let's call it nothing. If it does go above, you then can choose to say, hey, I could now get MicroStrategy shares at whatever price it's trading at.
Yeah, at the convert price. So I can convert.
At the convert, it's like a strike price.
It's strike price. That's right.
So if it's trading at $1,000,
I can get in at 672.41. Yep.
Yeah. Nice. Okay. So it is almost, let me ask a question. Is it a riskless bet on?
No. I mean, it's a corporate bond.
In no scenario did you just tell me where I lost money besides MicroStrategy going out of business.
Yeah. I mean, you lose money because you're getting less than the rate of inflation, but you lose money because you have MicroStrategies that might or may not be able to pay you back at maturity.
So it's the solvency of the company that's your risk.
That's right. Like any, we talk about a corporate bond.
Yeah, look, I'm deliberately asking the question that way.
I know.
And because you wonder, well, who's giving all this money? This is an upside, this is the lottery ticket, which maybe it's a lottery ticket that you only need 3 numbers to get right. But like, it's an upside, it's speculative, but you don't have, like, it's better to do this than buy the calls for 2029. Right, because there's no time decay. So, like, the reason why I'm saying this is, the question I get is like, well, who's giving all this money? Won't it ever run out? I think as long as people are speculating on Bitcoin, it's as long as you think they're not going to go out of business, which is your real risk here. It makes sense that people continue to pump money into these bonds, and he takes that money and does what? Buys more Bitcoin.
Right. That's what he's doing. Yeah.
And he's pushing up the value of his company with your money from the bond.
Yeah. Well, here's another example that might help people out. There's another of these bonds. Expires in 28. It's 0.625% coupons. This one actually pays a coupon. The convert price is 183.19. And last trade on the bond, again, I don't know when this traded, but it says as of November 27th, it was 232.47. So you would pay $2,324 for a bond that could mature at par of 1,000, but it gives you the right to convert into shares, 5.46 shares at 183.19. 19.
All right, so that we would, in an options realm, we'd say that's in the money.
In the money, correct.
Yeah, because it's trading at 387. So that's why you're paying this tremendous premium on the bond. In that scenario, you're taking MicroStrategy stock risk between here and the 183, right? Because you'll get back half your money in that scenario if it drops below the convert price.
Yeah, and in this case, you're in the money, as you said, but now this matures, and let's say it matures at par, which you get your $1,000. If you paid $23.24 for it and you only get $1,000, well, then you lose money there. So
if I converted that bond today, right, I get 5 shares at $387, so I get $1,900. Right?
5.46 shares.
5.46 shares times the price of the stock today, right?
Yeah, the price of stock today minus the convert is basically your intrinsic.
Oh, so mine times 200, which is basically the difference, right?
That's right.
And that's $1,000, $1,090, $1,000. So that's why it's trading at 2,000. You got $1,000 of what I would call intrinsic value, but the value, if you converted, plus the price of the bond. I guess because you're getting a coupon too.
And a little bit of premium. Yeah, I mean, there's premium on top of this.
Yeah, because it could go up, right? Sure.
Yeah. But even there's premium. It's not the intrinsic value that the bond typically trades at. You'll have some premium on top of that. So that's why when you hear him talk about, well, it's kind of like an option. Well, he's not wrong when he talks about convertible bonds as similar to options. So,
and where everybody could just buy these in their Schwab account.
I have no idea if Schwab lets you buy these.
I don't know where we'd even get one of these.
All right, let me do my disclaimer here. Like, what I'm talking about is, I mean, this gets into different levels of expertise and risk, and for most people, yeah, like don't do any of this that I'm telling you. I bring it up because I think there's so much bad stuff out on YouTube. You should see some of the junk. It's like, you have no idea what a convertible bond is. Some of these people, I'm like, oh my God. Like,
and they're talking about, so, okay, got it. So this was more, FYI, educational, buyer beware, just know your risk. Again, know your risk, and you're taking MicroStrategy risk, right? That's what you're
getting. Yeah, but that's, and I'm just looking at a Bloomberg screen. I mean, you and I are not doing deep analysis on these bonds. I pull it up on Bloomberg. I can see the conversion ratio. I can see the price. I can see the last price it traded at. They've got different provisions in here. Some of them have a call provision. Others have a put provision. They have dates where you can convert up to. There's green shoe options on here. There's different stuff.
Green shoe option.
Yeah, I'll say that for another time.
Oh, thank you.
All right. So there you go. We gave the people what they want. MicroStrategies. I do think MicroStrategies options are priced differently than when we saw like the GameStop things. Because GameStop's options were priced more equally up and down the chain, meaning it was really like the implied volatility, and I don't know. All right, I'll save that for another time. That's probably, you know what I'm saying though, right? Like you couldn't buy a spread, you couldn't sell a spread on those.
No, you couldn't sell a spread, right? Everything was just the same darn price.
It was the same price. That's what I'm going for. Yeah. Where MicroStrategies, it's a little different in how the up and down the chain is priced.
We've talked about it. Felt like the options were wagging the tail of the stock. Mm-hmm. That has definitely calmed down a little bit in the last 4 or 5 days. We just see it from our strategies. We have some funds that hold MicroStrategy options. And in those scenarios, we've definitely seen the market taking a necessary breather and brokers not feeling the crunch they did before. So there's some inside baseball there that I think everybody's just trying to manage through. I think a lot of folks are hoping. By folks, I don't mean investors. I mean institutions like primes and custodians that are hoping that there's a little bit of leveling out here and reestablishment of kind of a stable base before you have another expansion of volume. But we'll see. So far, I don't know. I don't think anybody feels like they're out of the woods yet when it comes to the risk that they have on their books. Brokers have a whole different set of risks than individuals do. That is something for another time. But I would say watch when there's a pinch institutionally for those options also to be the tail that wags the dog.
I remember I traded some GameStop options in like tiny. I'm talking like a contract, like a minuscule.
Just because you had to.
I had to be involved, and I actually in this one account I did it. So I actually got what's called a value at risk call from Schwab. I was TD.
You got a VAR call?
I got a VAR call from Schwab. So you can imagine this. I had the buying power in this account. It's like this tiny little play account. So I had the buying power in there, and I look on the screen. I'm in a call, and the guy called me, and I could tell he was. These probably were tough conversations, and he told me, and I said, "Is it a VAR call?" And he goes, "Yes." So I had to close it.
Yeah, we all saw the movie, which I know you made yourself watch the movie.
I did.
Dumb Money, which talked a lot about all the movings and goings that was happening in that stock at the time. But I would say that brokers can get to the point where they put you at closing transactions only, right? And some brokers had to do that, and that was called the way the movie portrayed it. It looked like it was some sort of scandal. It happens all the time on thinly traded names where you get, closing transactions only because they can't borrow enough to add more to their book, because that's what has to happen with clearing. And so if you don't know how that works, it looks like, they're not letting me buy more. They're gaming the system, or, that's not the case at all of what actually happened there. But I think you could see something like that in a stock like MicroStrategy. There's just not enough options out there yet to handle the amount of interest that are out that's there. So they need to do more shares, and maybe they'll do another split. Who knows? This thing gets to 1,000 again. Maybe they'll split it again. Or all the converts happen, and then you issue more shares anyway to just have more float. More float's good in scenarios like this.
That's the people who are saying, Michael Saylor's diluting the shareholders. Their argument is all these convertible bonds, they convert into shares. And now you have more of a float of shares and this and that. But, that's...
More shares are good.
I wonder if...
institutions.
I haven't traded any MicroStrategy's options, Jay. But I wonder if Schwab would have a VAR call if I did.
Not right now. Nope, not yet.
GameStop, they definitely
run into that yet. Even if you're, selling a call. I think you were selling a call, right? And so, yeah.
Yeah, I don't remember what I sold. I might have sold it.
That's not something we recommend, by the way. No. When we were asked, if you want to go back and listen to Derek's podcast from then, I
explicitly, and you did this well, I said, please don't do this. I said, people are going to get hurt. I was worried. I really was worried about what people are doing.
In a way, MicroStrategy is, in the front row of this show right now, what's going on with Bitcoin. And so it seems to be the hot topic.
Yeah. By the way, I bought, so we'll transition to our recommendation section. So my son and his friends went to go see Gladiator 2. And did you know, I bought tickets in the AMC app, and it asked if I was a shareholder, which I actually am not, but I don't know what they would do if you're a shareholder. Do you get a better price? I don't know.
Yeah. Remember that he did the apes? I can't remember, AMC preferred equity. I can't remember what was all built there. I usually use Fandango to buy my tickets. I don't use the AMC app. Maybe I should.
I don't know. We have Harkins and AMC here. Those are the two big ones. I don't know what you have there.
Yeah, I don't know.
All right.
I don't know. All right. So did you see Gladiator, or what did he think?
So my son said wasn't as good as the original. That's what he thought. And
it sounds like a Derek thing to say. If he said it wasn't as good as the book, that would be a Derek thing to say.
Yeah. Well, he had never seen the original. And I said, well, you got to see the original before you go to see 2. And he thought the original was better. He thought the story was, how much can I say about it without, he thought the story, the track of the story was very similar to the first one.
Oh, okay.
Just with, you haven't seen it yet, huh?
No, I haven't seen it yet. I'm sure I will. It seemed like it's more around Denzel, who is the owner of the Gladiators, right? The guy who's, putting the fights together. But who knows? Maybe that's just because it's Denzel Washington and they want to make
I would just say Gladiator, the first, it's one of the better movies you can see.
It won Best Picture, right?
Wasn't it nominated for 12 Oscars?
Yeah, I think it won. Gladiator. Who did the announcement? It was Elizabeth Taylor, right? I think I remember that. I could be.
And Russell Crowe won Best Actor.
Okay. Yeah. I like him.
He's kind of a good actor.
He's a pretty good actor.
He might be onto. He might have a future.
Yeah,
he tells a story.
His career closely.
Yeah, I mean, he tells the story. So Ridley Scott was the director, and he's told the story where Ridley Scott almost gave him a test, and he comes up to him and he's like, "I want you to picture you're about to go into battle, and you see a bird on the branch, and you stare at the bird." And it makes you happy, and then you're taken back to the battle, and then go. Literally, the guy, and then I guess he did everything, and Ridley Scott said, "Yeah, me and you are going to be great, man. This is going to work out really well." So, because he nailed it, but he gave him like a test or something like that.
So. We have an options test, Eric. We should, if people want that, they should email you. Get a copy of our options test. I've yet to see anybody that doesn't work with us directly to get every question right, except one of our YouTubers, one of the guys that follows our funds on YouTube. He got every question correct. Besides that, nobody else has. People should have. We should, maybe that's something we put out. We did a survey at one point. When it'd be fun to kind of do that again. If people wanted us to do that, they should email you, and we could put it out as a quiz, right? I think there's pretty cheap functionality. Just put out a quiz. People could just take it, see what it says.
Oh, maybe we should do it. Let's talk about that. Yeah,
okay.
But if people want to see that, they should email and let us know.
If you're listening to the podcast, you'll do very well on this options quiz.
I think probably. So, All right. So my son says not as good as the first one. That's what he says.
Okay.
I would recommend the first one. If anyone's not seen that, you got to see that.
Yeah. Great movie.
You ever seen Cinderella Man? It's another great Russell Crowe one where he's the boxer.
Yeah.
He's got some good movies.
In the Depression. Yeah.
Next 3 Days, that was a thriller. A little off the radar, but him and Elizabeth Banks were in that. Great movie. He's got some good movies.
All right.
Jay, anything you've been watching?
Let's see. I'm going to go see the Christmas movie Red One with The Rock and oh my gosh, his name is escaping me. The older gentleman. He does.
It's kind of like Rogue One, but it's Red One.
It's Red One. Yeah, it's like Red One, where like Santa gets kidnapped. Anyway, so that's on the list to go see. Looks like not a serious movie, but fun. Anything The Rock does, I recommend. But speaking of Rogue One, that was going to be my recommendation. So we ended up getting a new projector TV, right? This is kind of a improvement on the house. And the first movie we watched was Rogue One. It's just incredible movie. We talked about it internally the other day, and just to Rogue One, the Star Wars movie, outstanding. Might be the best Star Wars in my opinion after the original, but great movie. I'm going to throw back to Rogue One.
If you watch the original, and that's the one that is directly after it, literally, I don't want to ruin it for anybody, but it's directly after the original 1977, A New Hope one. That's just a great pairing, because then you'd watch Rogue One first, and then you'd watch. I got my order there wrong, right? Rogue One came before.
Rogue One came and ended probably an hour before the second one starts.
You and I were talking, by the way, we reminiscing about waiting in line to go see Empire Strikes Back in probably 1980?
1980, yeah.
This is how technology increases productivity. Could you imagine today? Like now, you go on the app, you reserve your seats, you show up when the previews are still ongoing, you go to your seat.
Yeah, that's not the way it was. You get in line, and hopefully they weren't out of tickets for that show. And then you rush in there and you try to get a seat. It was mayhem.
Yeah, if you're with five people, you're like, I don't know, maybe we'll sit together. Maybe we can't sit together. Maybe I wind up like the first seat in the front row, looking up at the screen. I have vertigo afterwards, So
I did that with Lost Boys. I got stuck in the front row of Lost Boys.
1987, right? Or that was 87.
Yeah, late 80s.
I saw that at Paramus Park, the 10plex on Route 4. I saw that.
That's where I saw it too. It was the RKO Theater. So those of you from North Jersey who know what the heck we're talking about.
We very possibly could have been at the same movie.
Well, I was in the front row. Surprised you didn't see me.
I was not. All right, Jay, that's it.
Have a good one, Derek.
We'll be back next week. See you, everyone. Thanks.